Hi, welcome to Top 5 Reasons Short Sales Crash. I'm Dave Peoples with Century 21 First Realty. Feel free to email me at any time with comments or questions at dpeoples@manasa.com, and I generally respond to all emails within 12 hours. And feel free to check us out on our company website, manasa.com/blog. Okay, the first reason why short sales crash: the bank is not provided with complete or accurate information. Listed below are items that are typically required by lenders to start a short sale packet. And they're going to look for financial information from the seller, a hardship letter, 2 years income taxes, last 2 bank statements, the last 2 pay stubs, a listing agreement which shows that the seller hired a real estate company to sell their home, a preliminary settlement statement showing the lender how much they'll net after all expenses, and anything else that the lender may come up with. Of particular note, the 2-year income taxes and the bank statements for some reason seem to give the borrower hard time for whatever reason. This is what I run into a lot. And if you can't come up with all the documentation, at a bare minimum what you should do is at least have the seller write a letter of explanation why they cannot come up with whatever specified material is required by the lender. It's not a perfect solution, but it's better than providing nothing at all. If you submit a packet that's incomplete, the bank's not going to refuse the packet. They're going to accept it usually, and they're just going to put it at the bottom of the pile. You've got to picture the person answering the phone as an hourly employee. They've got a long day, they've got a tough life, they've got a job they probably don't really enjoy. They're probably going to work on the files that are complete as opposed to the files that are incomplete. So just put yourself in their shoes and make their job as easy as possible. The second reason why short sales crash is your buyer's not committed. Many times they'll get antsy after a few weeks and bail out. They'll want answers and wonder why the bank hasn't given them answers after 3 or 4 weeks. They might be an end user home buyer and just not have the time to wait around to see if a deal can be worked out with the bank. Their price might be unrealistic. They might be coming in at 40% of fair market value and jerking everyone around. Many times the buyer doesn't have an exit strategy. They might not really know what they're doing. They might not really have a plan. They may be going out there and just fishing for a great deal, and then even if they find one, doesn't mean they're necessarily going to take it. And then the fourth reason why your buyer might not be committed is they might not even be qualified to purchase. You could go through all this process and through all the trouble and then find out that your buyer's not even really qualified to purchase. They might not be ready, willing, or able to make the purchase when the time comes. So make sure you qualify your buyer up front, obviously, before you start wasting a lot of your own time. Number 3, reason why short sales crash is, believe it or not, if you've done any short sales at all, you know it's a very disorganized process, or it can be anyways, but the bank loses your packet. Okay, sometimes this happened because they sold the loan. Sometimes they lose your packet because they changed loan servicers. Sometimes they just lose them. And if you're not organized, they lose the packet and they claim they never got it, and you say, well, I just sent that to you. It can be no big deal if you're organized and you can just resend it over to them. But they're going to lose parts of your packet, if not the complete packet. On almost every short sale at some point, something will be lost. So keep good records and be able to get them what they need quickly. This is a very common reason why short sales crash. The BPO is returned too high. The BPO is a broker price opinion. That's just an acronym for broker price opinion, and it's basically a cheaper form of an appraisal, usually done by a real estate agent, not party to the transaction. Okay, so the BPO agent usually gets paid $250 or something like that to go out there and do either an interior or exterior broker price opinion of the property to gauge whether the offer is realistic or not. The banks put a ton of belief in the broker price opinion. They don't know the agent's doing the BPO. They just know that the agent isn't party to the contract and not going to receive a commission as the outcome of the deal. So they put a lot of faith in the BPO and not a lot of qualifying standards. So the BPO agent could have been unrealistic when they go out there. The bank might have been waiting for the BPO to come back at a certain price. The bank may have had an agenda. I don't find this too common, but I have heard about it, and sometimes it appears as if the bank tries to influence the BPO to hit a certain number for whatever reason. I guess maybe they just want to stick their head in the sand and not believe the truth on occasion. Then lots of times the BPO agent, as required by the bank, assesses current market value based on sold listings versus what else is for sale in the area. For example, in a subdivision, there could be 5 houses for sale with an average list price of $150,000, whereas there might have been 3 sales last year at $220,000. Those sales might have occurred well over 12 months ago. In certain cases, the bank still wants to base today's values off of what happened a year ago, and then the BPO agent really isn't incentivized to fight for the truth. They're just incentivized enough to get their $250 check. So reason number four, very, very common, the BPO's return too high. It's critical to get your short sale closed, to work closely with the BPO agent whenever possible, to make sure their work is solid. And so you guys are in agreement and you understand where they're coming from when they report to the bank what their opinion of price is. Number 5, and then the final reason why, one of the final top reasons why short sales crash is you run out of time. Okay, you can run out of time for a variety of different reasons, but an additional encumbrance can be found. That could be one reason. Your seller may not have known, or he may have forgotten, or he just might not want to have told you about maybe an IRS lien against a property, or a tax lien, or a homeowners association lien, or something like that that threw off the bank's numbers. The lender might just not have postponed an auction sale. They might have just let the property go to sale even if you had a deal in the works. That's not usually the case, but they can do that. And then most often you'll run out of time when the first and second lien holders cannot reach an agreement. There used to be a general rule of thumb where the second lien holders would take 10% as a payoff on their loans, and many times the first lien holders don't want the second to get anything more than $1,000 or something like that. But that happens quite frequently where first and second can't agree on what happens, and therefore you run out of time in the process. So in a nutshell, those are the top 5 reasons why short sales crash. I appreciate your feedback, comments, or questions at dpeoples@manasa.com. Come check us out at our company blog, manasa.com/blog, and have a good day. Thank you.